Good afternoon, everyone. Thanks so much for joining us today. My name is Ashley Sullivan, and I'll be your host for today's webinar on staying in compliance with the Bank Secrecy Act. Before I introduce today's presenter, I'd like to go over some housekeeping items. Today's presentation will last about 45 minutes, and the slides can be downloaded at www.wolfandco.com/webinars/2012. If you have questions at any point throughout the presentation, please send them in to me using the questions box located on the control panel on the right-hand side of your screen. We'll answer your questions at the end of the presentation. You have two options for audio today. You may dial in by phone or listen through your computer. Our audience will be muted during the session, so if you need to communicate with me during the webinar, please use the chat box, also located on the webinar's control panel. I'd now like to give a brief background of the firm. Wolf & Company was established in 1911, and we are very excited to have just celebrated our 100th anniversary. Building on our tradition of unparalleled guidance, we provide our clients with assurance, tax, business consulting, and risk management services. We have over 180 professionals working for the firm and have offices in Boston and Springfield, Massachusetts, and Albany, New York. We currently employ over 45 risk management professionals in the areas of IT assurance, internal audit, regulatory compliance, and Wolfpack integrated risk management, and provide services to nearly 250 financial institutions in 19 different states and 1 U.S. territory. And now I'd like to introduce today's presenter, Brian Shea. Brian is a supervisor in Wolf's regulatory compliance group. Thanks so much for presenting today, Brian. I'll now hand the presentation over to you.
Okay, thank you, Ashley. Before we begin, I just want to briefly discuss what our objectives are in today's webinar. So first thing we're going to take a look at are some recent changes to the Bank Secrecy Act regulations and just the overall expectations out there. So far this year, there's been a number of things with respect to the Bank Secrecy Act that have changed or have received some sort of clarification in some way. I also want to cover some important areas that, while these areas haven't necessarily changed, there's still areas that are always high priority and high focus, and they're always really good areas to cover in a session such as this. And then lastly, throughout the session, going to be discussing really how your institution is impacted by these changes, clarifications, updates, and really what your institution can do to ensure that you're continuously in compliance with these rules. So our outline for today, we're going to start with a brief introduction. Then we're going to spend a lot of the time on the various regulatory updates that have happened with respect to the Bank Secrecy Act. Following that, we're going to be talking about the continuously high priority or high risk areas. And at the end of the session, we'll take some questions. All right, so from an overall introductory standpoint, Bank Secrecy Act continues to be a very high risk area out there for financial institutions. Even though BSA wasn't a hallmark of Dodd-Frank, and obviously Dodd-Frank's imposing a whole bunch of different rules on us, BSA is still something that's a very high priority, very high risk for institutions, and something we have to assure that we're still continuously in compliance with. Just look at the news recently. You'll see several large institutions that have been criticized pretty heavily for their BSA performance. It goes to show that no matter how large, no matter how many resources you may have, BSA is still an area that you can hit some heavy criticism from. And because of that, it's very important to make sure that your program is always up to date with respect to any rules that are out there, clarifications, or any just overall guidelines that examiners are looking for with respect to BSA. A couple of recent examples, just good points to show why you want to make sure your BSA program continues to be up to snuff and compliance. Just a few months ago, Citibank was heavily criticized for BSA issues, and particularly having a lot of problems in terms of identifying their high-risk customers, something we'll talk about in a little more detail later on. Issues with SAR timeliness, independence, just support for staff. So overall governance seemed to be a problem with them as well, and that's something we'll focus on a little later on. Even more recently is HSBC, so just within the last couple of weeks, being very heavily criticized by the Senate, having a major report issued on it about all these major BSA and AML problems that they're having. So these are things like allowing criminals, terrorists to maintain accounts, letting them just go right through the OFAC list without a problem. Similar to Citibank risk ratings, big problem. they're having issues that they're not really taking steps to correct, and just an overall poor culture with respect to compliance. I think these examples show that no matter how large your institution is, you can still have major BSA problems. It's very important to make sure you're up to date with respect to any of the rules that are out there. All right, so now we're going to talk about some of the various things that have changed or have updates with respect to the Bank Secrecy Act. These are areas that principally have changed sometime this year or have had guidance, advisories, something like that come out at some point during this calendar year. So we're going to briefly talk about electronic forms, which has really just come into play the last month, at least from a mandatory standpoint. We're going to be talking about some various minor subjects, aggregation, exemption, updates, things like that. We'll also be focusing a lot on suspicious activity reports and guidance, and especially customer due diligence towards the end of the session where we're talking about those things that are coming out. Okay, to start off with, I'm sure most of you know by now that electronic filing has become mandatory. So this is actually at the very start of the month, July 1st. Certain BSA forms are now officially required to be filed in an electronic manner. Many institutions were already doing things electronically. So if you've been doing that for years, not a lot of things haven't really changed much for you. But if you were an institution that was still going through the paper filing, now you're officially required to ensure that your reports are filed electronically. The 3 reports you have to make sure you do this for are the CTR reports, the SAR reports, and then those designation of exempt person forms if you're doing any exemptions. Please keep in mind that FinCEN really is no longer accepting paper filings. So if you send in the paper report and it's past the deadline, you're essentially going to be treated like you never filed the report in the first place. So just keep in mind that starting at the start of this month, all of you should be doing things in electronic fashion. There are a few forms out there you don't have to worry about filing electronically. The odds on these reports, in all odds, you may not even have to worry about these reports anyway. These are reports that don't really come up too often, at least for the types of institutions that we deal with. This includes the CMIR report. This is a report you have to file with $10,000. Over $10,000 is coming in or out of the country. There's also an FBAR report regarding foreign bank accounts. This also can still be done in paper form. This is one that is also transitioning to electronic filing in a little under a year. All right, another thing to keep in mind for electronic filing, again, this will be something new to those of you that have been doing it in paper all this time, is the fact that you do have an extended time period to send in the CTR. So the official rule in the reg is 15 days after the transaction date. If you do things electronically, you now have an additional 10 days on top of that. Just keep in mind that this is going to be reverting back to 15 days in about, a little over 6 months at this point, basically on March 31st. So keep in mind, for those of you just getting used to this process, but also those of you that have been used to electronic filing for a while and have always had this nice luxury of the extra 10 days, that is going to be going away at some point early next year. All right. There's a few limited exceptions out there. Not really going to spend much time on this because I think in all odds, few if any of you will even be impacted by these. But there are a few exemptions out there if your institution's having really hard problems in terms of being able to file electronically. The first one is if you're a small credit union without internet access. So in all odds, if you're attending this webinar, you don't have to worry about this problem. So I'll go right by that. There's also situations where if your aggregation system is really incompatible with the e-filing system. They're giving you an ability there. This only applies to CTRs though, so watch out, you still have to worry about setting the SAR in the exemption forms. And this is an exemption that is going away at the end of the year. So even though it's out there, it's not going to last that long. They've also allowed temporary hardship exemptions as well for extraordinary circumstances. Just keep in mind this is for extraordinary circumstances. So, let's say, for example, you just weren't getting well prepared for this and it just came up all of a sudden. That's not an extraordinary circumstance. That's just not planning well. So keep in mind that this is out there as well. Each of these, you'll see again, they kind of carry expiration dates with them. So even this extraordinary circumstance exemption won't be lasting that long. Okay. Another new thing with respect to these forms is that we're actually transitioning to new versions of the forms themselves as well. Now, at this point, the new forms are out there. They are able to be used, but they're not mandatory yet. So the mandatory date for the new forms is going to be that March 31st date that we've already seen a few times. The way they're referring to the old forms now, so the forms we've been using for a number of years, is legacy reports. So if you're ever hearing That phrase used, that's what it signifies. You are allowed to continue to use these legacy reports through that March 31st date. You're actually even allowed to start using new forms early if you want as well. So if you want to go ahead and start using the new ones, they are considered those acceptable. And you can also do any combination. So if you want to use the new forms for a certain type of CTR form, for example, but still use the old forms for the other types, they're allowing that at least temporarily, keeping in mind that this expiration date is going to basically be out there, and you'll have to use all the new forms starting on that date. Okay, the reason for the new forms is just to basically help law enforcement and regulatory agencies. There's more data elements on the forms that kind of gives them the ability to be able to sort their information, to be able to find the information they need in easier fashion. I have a few slides here briefly discussing some of the new things that you'll see on these forms. So to start with, on the CTR form, you'll see a few additional fields added, such as email address, phone number. You'll see NAICE code as well. So obviously NAICE codes are codes to identify certain business types. There's actually new transaction types as well. This is just for a few types, such as prepaid access, advanced on credit, things like that. First time you look at the form, you might see some additional fields that just won't look that familiar to you, things like gaming devices, stuff like that. If you see any of those, I wouldn't worry about it. It looked to me, looking at the new form, that they're combining certain fields from other industries, not just banks and credit unions. So you might see some fields, for example, that would apply to a casino, for example. Then in all odds, you'll never have that transaction type, but you'll probably see it on the new form. All right, in terms of the SAR form itself, you'll also see some similar new fields, such as email address, website address, the NAICE code. They have added a few additional roles for subjects, such as purchaser/sender and payee/receiver. A little more information regarding law enforcement, if you were involved at all with law enforcement during your investigation. For those instances where you're filing supplemental SARs, they've added some fields to kind of indicate that the SAR you're filing is representing cumulative activity and is not just a isolated instance. You'll actually have the ability to have a cumulative amount on that form. Similar to CTR form, there's just some new transaction types they're having on there. The big thing you'll see is that they've broken out the suspicious activity type in a lot more detail than we're used to. So you'll see a lot more level of information there. You'll be able to get a lot more detail in terms of the specific type of suspicious activity that's occurring. And this really gets back to the purpose for the new forms, which is to help FinCEN and law enforcement more easily identify the types of activities that they're looking for. Just like the CTR, you might see a few fields or a few new areas that you won't really be familiar with. And these are really just because they're incorporating certain information from other industries in there, such as casinos, brokers, and like. So keep in mind, if you do see fields like that never really come into play for you, I wouldn't worry that much about it. All right, I have included links here to the new forms. So if you do want to see the new CTR form and the new SAR form, you just have the ability to use these links, and you should be able to see what they look like. All right, so that pretty much covers new forms. The next thing I want to discuss is just some new CTR aggregation guidance that had come out earlier this year. Basically, the reason for this guidance is situations where an individual might have an ownership role in multiple companies and is processing deposits through your bank. At times, it can be kind of confusing about whether or not the bank is supposed to be aggregating these transactions. So FinCEN had issued this guidance in March of this year to provide a little more information on what financial institutions should do. Basically what they've said is that if the businesses are separately incorporated, then typically what you should do, at least initially, is assume that they're different entities. So just because they are owned by the same individual doesn't mean you automatically want to aggregate that activity. That said, based on the specific circumstances that occur, there might be situations where you do want to aggregate the activity, and that's really going to be dependent on what's actually happening regarding that particular customer in terms of their deposits. Include some information on the next slide. They'll provide more clarification for really what they're looking for in terms of those scenarios where you would be aggregating. So they've given some examples here to say, okay, in these situations, in all odds, these businesses probably aren't operated independently from one another. They kind of are maybe dependent on each other, and you may want to determine that particular situation that you should be aggregating for CTR purposes. So for example, if these businesses are all the same address, staffed by the same people, if you're seeing the owner repeatedly using money from these business accounts to pay their personal expenses, situations like that, this guidance basically points out that these are probably situations where you do want to aggregate the activity. All right. Obviously, you want to be consistent. So, if you've determined that, you just want to be consistent across the board going forward. Obviously, it's going to be the specific circumstances that are going to come in play for each individual customer. There's no universal situation, no universal thing that I can say, hey, this is the rule you want to apply across the board to everybody. But at least, hopefully, this aggregation guidance should provide a little more clarification for institutions when you have these situations where you have somebody who owns multiple businesses. And you're wondering to yourself, should I be aggregating these or should I not be aggregating these transactions? I have included a link to the guidance at the bottom of the slide. Throughout the rest of the slides, you'll see that I have referenced specific advisory numbers or guidance numbers. So it should be pretty easy for you to find these particular things via FinCEN's website if you want to look at them in more detail. All right, we had some changes to the exemption rules. These rules were thankfully pretty basic, so not really something you have to worry about. A lot of you may not even have these types of customers anyway. But basically what it is there are two separate rules under Phase 2 for exemptions. You have non-listed businesses and you have payroll customers. And these amendments were just basically make things a little more consistent when we're talking about payroll customers and non-listed businesses. So there's a standard for non-listed businesses that the type of business is basically doing a lot of reportable transactions. If they're doing at least 5 in 1 year, it's over $10,000. And basically all these amendments are really saying is just posing the same standards to payroll customers. So if you have a payroll customer, somebody who's coming in, withdrawing a lot of cash, over $10,000, and then using that to pay their employees, if they're doing that at least 5 times a year, you are allowed to say that basically they're performing, a bunch of reportable transactions. Obviously, keep in mind there's other rules you have to worry about from an exemption standpoint, but at least from a number of transactions standpoint, we've now got some consistency there for Phase 2 listed, non-listed businesses and payroll customers. All right. Some additional guidance that we've seen recently. This is one of those rare situations where it's good news for the industry. I was certainly very happy when I saw this. Basically what it is earlier this year in May, FinCEN issued a STAR activity review. They had some guidance in that review pertaining to supplemental STAR filings. So for many years, the reasoning for these, and this has even been in specific written guidance and exam manuals for FinCEN, is that the expectation is that any supplemental STAR you're filing, so basically a situation where your suspect is still performing the suspicious activity after the STAR has been filed. Basically the standard has always seemed to be, for many years, 90 days. So if I file a STAR today, I've got to get that second or supplemental STAR filed within 90 days of the day I filed it, assuming, of course, that the activity is still happening. This guidance has actually provided some clarification to state that you're allowed to wait that 90-day period, and then you may perform basically an investigation over the 30 days following that. So effectively what we have now is 120 days since the previous STAR. So luckily, again, this should provide some additional timing, some additional resources. Ideally, you get a full more month on top of what you had in the past to basically go through the case, determine does this activity warrant filing another STAR on this individual. And obviously, this will just apply continuously until the point where the activity stops or you close the accounts out. All right, there's also some additional guidance that has come out regarding attorney requests for STARs. So FinCEN has seen private parties requesting STARs at a greater frequency than in the past. And really, this advisor is just reminding institutions that these are situations you want to be really careful about. If you're ever sending that STAR out to an unauthorized party, obviously your institution can get in a lot of trouble. Certainly from a regulator standpoint, it obviously breaks the rules of the reg of the law. So you want to be really cautious about any situations where just some private attorney might be requesting a STAR from the bank through a subpoena or something like that. If there are any situations where you're aware where it is an unauthorized request, they are just requesting that you contact FinCEN. And you should probably also consider contacting your regulator as well. All right, we've also had some rulings that have come out that pertain to money service businesses. Now, obviously, we're financial institutions. We don't have to really worry about registering as MSBs. At the same time, if we have any MSBs in our customer base, it's certainly a good idea for us to be up to date in terms of, all right, what classifies as an MSB, what does not classify as an MSB. So, admittingly, while your institution probably won't have to take this advisory or ruling and say, now I have to get registered, something that might help when you're looking at a new customer or an existing customer and trying to figure out if this is an MSB or not. All right, so basically it's 4 different advisories and rulings that have come out so far this year. And just had a quick recap on the slides for really what they're talking about. The first one we had 2012-A001, just regarding the location of the MSB. So basically this advisory clarified that even if you have an MSB that's headquartered or basically physically located in another country, if that MSB is performing activities within the U.S. that basically require to register as MSB in the U.S., then that specific situation, that's definitely an MSB, and definitely they have to worry or make sure that they get all their registrations in place. Another ruling, this is ruling R001 that had come out this year, was regarding holding company situation. So basically the situation where a holding company had a bank underneath it, and there was basically some negotiable instruments that were being issued by the holding company. Ultimately, what the ruling said is what the entity did not have to worry about getting registered because of the nature of the specific instruments it was issuing. That said, the key thing I did see as part of this ruling is that just because a holding company is associated or affiliated with a bank or credit union, in that specific situation, that doesn't automatically make it exempt from the MSB requirements. So just watch out in this situation if you do have a holding company that is potentially doing money transfers, issuing monetary instruments, or anything like that. If it's through your institution, if it's through the bank, in all odds, probably okay. But if the holding company directly is doing these kind of things, something to consider from an MSB standpoint. Okay, we had another ruling, R004, regarding a specific type of company that was collecting a bunch of expenses for its customers. So basically they collect a lump sum at the beginning of the month. They'd find out what bills the customer owes during the course of the month, and then this company would basically arrange to have all the payments made. So they actually considered this particular company a money transmitter, which hence makes an MSB. All right, the other ruling we saw out there was just regarding a situation where a third-party company was issuing prepaid access, basically. I should say the bank was issuing the card, but the company was actually selling the card. So in this particular example, the bank was really exercising the oversight over the relationship. So they just clarified that as long as that particular company is not meeting this prepaid seller definition, then that company did not have to get registered as an MSB. In this particular situation, from a prepaid seller definition standpoint, basically what that means is if the prepaid access, so the stored value cards essentially, can be used before any identity verification is done, or if it's done over 10,000 per person per day. That's a situation that could trigger that definition. Okay, there's a few other guidance or advisories that have come out. We're going to have a few other subjects that I'm just going to briefly cover. And again, you can start to look at these in a little more detail to get information on them. They had issued a tax refund fraud advisory early in the year, or around tax time. So this advisory is a helpful source regarding various red flags that might come up from a tax refund fraud standpoint. They did say within the advisory that they're looking for specific language in the STAR narrative if this comes up. And we've seen this a lot through a bunch of different advisories over the last few years, where, for instance, requesting that just a specific phrase be included within a narrative. That kind of helps them look through these things and identify these stars in easier fashion if you're including these keywords in it. So at least in this particular situation, they recommended including tax refund fraud within the narrative if you ever see a situation like this. So again, just in the interest of time, I'm not going to go through all the specific red flags for this advisory, but it's certainly a good resource to take a look at in terms of identifying suspicious activity. Another advisory, and this one's really recent, just had come out under 2 weeks ago, was regarding just some U.S. currency restrictions in Mexico. So Mexico has implemented some restrictions in terms of U.S. currency, which they think may have caused or will cause more fraudulent activity to come into the U.S. Obviously, we're up in the Northeast, so in all odds, we're not going to have to worry that much, maybe even at all, about this. But I just include here just in case. So similar to the tax refund advisory, they just are looking for a specific keyword phrase in the narrative if you ever do come across any of the activity. Okay. So those are some of the various things that have come out over the course of the year. This next thing has not officially come out yet, but it is pretty important, so I did want to make sure I mentioned it was part of the session. So a few months back, FinCEN had actually issued a notice of proposed rulemaking to say that they're considering putting into place additional customer due diligence rules. They just issued this notice of proposed rulemaking, meaning they haven't issued a proposed rule yet, certainly not a final rule yet. At this point, they're really just getting information to help them put together this proposed regulation. Principally, what this new rule is going to pertain to is beneficial ownership. So FinCEN is really looking for institutions to collect more information regarding beneficial owners of accounts. And then obviously that information will kind of flow throughout the enhanced due diligence process. If you look at the current rules, again, there's not too many situations where you're officially required to get that beneficial ownership situation. If you have private banking or foreign correspondent accounts, then I can say, pretty much very few, if any, of the institutions I deal with even offer such accounts in the first place. So in all odds, your institution probably doesn't have to worry about those. There may potentially be situations under your CIP program where you're collecting the beneficial ownership information. For example, if you can't identify the business entity, there is the ability to say, I'm going to identify the owners of that beneficial of this business entity. So that's, at least currently in terms of official rules, I mean, that's about it in terms of when you're officially required to get this beneficial ownership information. FinCEN is looking to kind of expand the rules and make it required in more situations. Looking through their notice of proposed rulemaking, they kind of had this breakout or discussion of really what they consider an effective customer due diligence program. So really include these 4 key steps that we see here. Starts off with the initial due diligence on the customer. So this includes collecting appropriate information and certainly verifying their identity on a risk basis when that account is opened. Understanding the purpose and activity, or what's going to be happening on that account. Obviously, that's important, so you're able to tell whether or not the activity that's happening is, what's expected for that particular customer, or maybe it is suspicious or unusual activity. The third thing they included in there was identifying the beneficial owners of the customer and just verifying their identity based on the risk. And then it concluded with basically performing ongoing monitoring and due diligence on those customers so you're able to identify suspicious activity. I think most people looking at this will say, hey, Brian, a lot of these rules I'm already doing. And they've pretty much admitted to that extent in the notice of proposed rulemaking they said out there. Basically, the big new thing will be the third bullet, the identifying of the beneficial owners. So I know they said, there are specific references in the rule that said that institutions already have obligations regarding these areas, with really that beneficial ownership being the key new thing. Here's the definition that they had of beneficial ownership within that notice of proposed rulemaking. So basically what they're saying is individuals who directly or indirectly own more than 25% of the equity interest of that business or entity. If there is nobody who owns that much, then what they said is the person who basically directly or indirectly has at least as great an interest as anybody else. They also specified that if you have an individual with greater responsibility than anybody else for managing and directing that entity, then they include that in the definition as well. They are considering certain alternative definitions, certain exemptions as well, so certain types of businesses or customers where you won't have to collect this information as well. So that's kind of in as well. So, at this point, all this is still, even pre-proposal. So, don't, thing I'd say is, don't take this away and automatically consider this final and things you have to change your programs for. Just keep in mind that this is something that's coming down the pike. It's definitely going to be happening. They're still collecting information for it and how to kind of help them establish a formal rule. I think they're even having a formal hearing today, I believe, on this subject. Okay, so those are basically a coverage of some of the things that are new or updated that have come out over the course of the year thus far, and a few things that are coming up. The other part that I wanted to discuss as part of this webinar is areas that haven't really changed, but at the same time, these are areas that are still very important, very critical. and deserve a lot of attention from you. If your examiners are coming in, these are the types of things they're definitely going to be looking for. And these are the types of things that if you go again to the news, those couple institutions I mentioned at the start of the presentation, part of the reason why they're having all these issues are not complying with areas such as these ones. So really the big three things I want to discuss were governance, the application and use of automated software, so basically what the expectations are for your institution when you're using it, and then enhanced due diligence. All right, so I'm going to start with governance. So governance is very critical as part of the exams. I mean, obviously it's critical for compliance as a whole, for your organization as a whole, but it's obviously critical within your BSA program too. When your examiners come in to look at you, I think we're pretty much past it at this point for those days when an examiner will just come in, look at areas and say, okay, you have 5 technical violations. Here's the violations. I'm going to leave. At this point, if examiners are coming in and seeing a lot of issues, a lot of weaknesses, they're going to be looking at your program as a whole. And they're going to be looking at governance within your organization as a whole as well. If you're having a lot of BSA issues, certainly they're going to say, well, are the people who are responsible for BSA doing things appropriately? Is the senior management of the institution doing things appropriately? Maybe the BSA people, have the right mindset, know how to go about it, but maybe senior management is providing them the necessary resources or commitment. So just from an overall governance standpoint, it's something that's very critical. You want to make sure you have appropriate and proper governance at your organization, and hopefully that will avoid any particularly major issues, major breakdowns within your programs. I've included a list of some certain things to consider when it comes to governance within your program. So certainly an important thing is just resources. Does your institution have enough resources to ensure that you can comply? So we talked about resources. Obviously, probably the biggest thing is staffing. Do you have appropriate staff to make sure that you can comply with the requirements? Do you have the appropriate commitment? Do you have enough in terms of funds, budgeting, that kind of thing? Do you have the necessary technology? It's very important that you have enough resources to make sure that your reports can be reviewed, reported in a timely manner, and just to basically make sure you meet all your BSA obligations. You could have a terrific setup program in terms of identifying activity, but if you don't have enough resources to go through and review that activity, you're still going to get absolutely slammed by your examiners when they come in. Another important thing from a governance standpoint is those situations where you're accepting the risk. So ideally, this is not something that comes up too often, but every once in a while, you just might have to be in a situation where you've got to make a business decision that there's a certain level of risk here, and that we have to accept the risk. Probably the most common example I can think of is institutions using a certain dollar threshold for OFAC purposes. I see a lot of institutions have dollar thresholds when any sort of OFAC transaction happens at a branch level, such as a payee on a monetary instrument, a purchaser of a monetary instrument, that sort of thing. So that's just an example. There could be other situations out there. I've seen currency exchange monitoring, things like that, where there's thresholds where risk is basically accepted under a certain level, that kind of thing. If you do that, again, just keep in mind you've got to have documentation. You have to have backup for that. Your examiners, when they come in, they'll probably be asking for information to help support why you made that type of decision. So I'd certainly say make sure it's clearly documented in writing, make sure it's available in case people need to see it. I'd also say make sure it's approved at high levels of the organization. Preferably at the board level. At the very least get to senior executive management, because it's certainly something where, I've faced situations before where, BSA officer might be willing to accept the risk, but upper management may not be willing to accept the risk. So just keep in mind that that should be documented and appropriately communicated throughout the organization. Making sure there's an appropriate reporting line in the organization is critical as well. Do the business lines have the appropriate knowledge to know that this is suspicious activity? Do they have the ability to report that suspicious activity to the appropriate personnel within the organization to make sure that we can identify and report the information through a SAR as needed? Certainly we've seen institutions criticized where, for example, the mortgage department has tons of findings, tons and tons of fraud or, loans that go bad, things like that, and then they never tell anybody on the BSA side. Then the examiners come in, they notice this activity, and now your institution is being very heavily criticized because people are not communicating with one another. So it's just definitely important to make sure there's appropriate reporting structure and that people know to report to the BSA people as appropriate. All right. Obviously, BSA is looking at a lot of existing products, existing services, but whenever you're developing a new product or service, you want to make sure that's taken into consideration as well. Hopefully, your organization is taking into account compliance when it comes to new products and services, and you want to make sure that BSA is taken into account there as well. Certainly, you'll face things such as customer identification. How does this work into our CIP program? From an OFAC standpoint, how does this new product fit from OFAC? Suspicious activity monitoring. Do we have the ability to capture this new product or service through our existing processes? Do we have to develop new processes? Things like that. All right, and then just another critical thing is this, vendor or service provider due diligence. If you're outsourcing anything to do with your BSA program, you just want to make sure you perform appropriate due diligence. You want to make sure you have things ideally in writing from that third party. They will attest to or assure to your bank or credit union that they're doing things properly, especially if you're entirely outsourcing a particular task or function. So, if you have a product type where, let's say, the third party is doing all your OFAC database reviews or your 314 reviews or something like that. If they're doing that, just make sure you've done the appropriate due diligence, and ideally you have something in writing that shows that, yes, they are doing this. All right, so that pretty much covers the major points I want to talk about from a governance standpoint. Another big thing I'm seeing out there that I just want to discuss, again, to help make sure everybody's well prepared, is the usage of automated software. Obviously, automated software is becoming more and more popular in the industry. I'm seeing more and more institutions using it. Just keep in mind that moving to automated software does not automatically solve all your problems. There are certainly risks involved. There are certainly processes that you want to make sure are in place if you're using the software. The software is only as good as you use it. It's only as good as the controls you put in place surrounding it. So I just want to cover some important points when it comes to using automated software to make sure that you're not getting heavy criticism from your examiners. Obviously, and this kind of flows with what I was just talking about in terms of the service provider or vendor due diligence. Just before you put it in place, just make sure you do the appropriate research, see whether the software is going to appropriately fit within your organization. Make sure that they provide all the information that you think you're going to need. Certainly, if you're going to stop using certain manual reports or manual processes, obviously just make sure that the new automated software they're moving to actually covers those things so you're not going to be doing manually anymore. From a parameter or rule standpoint, so obviously your parameters or rules are really identifying what specific scenarios are that specific software going to be pulling out to identify suspicious activity to you. So basically those alerts, for example, I think that's what they're typically called throughout the industry. When the software pulls the alert, it's because this customer has broken certain parameters or rules. You just want to make sure that those parameters or rules that have been set up are appropriately customized based on your organization. Typically the vendor offers a out-of-the-box setting essentially, so just a standard setting. You'll want to make sure you go through those and set them accordingly based on your own activities in the organization. We have seen examiners come into institutions that basically made no changes whatsoever to the parameters, and then the examiners said, well, hey, you're a little different in terms of your types of activities, your customer base here, and you haven't really adjusted your parameter rule to reflect that. And as a result, suspicious activity just is not being captured properly. So just keep in mind that they usually do provide these out-of-the-box settings. Just make sure you go through them. I mean, you might find a lot of them are perfectly fine, but you want to make sure you customize them as you think needed to reflect the actual types of activities that your customer is going through. That kind of also goes in hand with any future events that happen. So, if you're seeing situations that warrant changing the rules of the parameters, it's definitely something you should consider going through with. A certainly big concern I see from a lot of the institutions I deal with when they start using automated software is the volume. A lot of times the automated software is producing tons and tons of activity, and a lot of it ends up being false positives. And obviously, you don't want to spend too much time, going through all this activity that at the end of the day is just going to result in a false positive. So, there are certainly situations where you want to adjust those parameters to kind of make sure you don't get these situations, or at least lower the number. Obviously, nobody can ever 100% eliminate the false positives, but if you can at least reduce the number, it's always good because that'll give you more time to focus on what's really important. The thing I'll caution you on is if you're doing this, it really has to be risk-based, has to be BSA-based. Don't say, for example, I don't want to spend the time going through this, so I'm going to adjust the parameters so I don't see as much, and then I'll basically, close my eyes and act as if it's not happening when it still is. But, if you're seeing things that are just structured, and you think from a risk-based standpoint you're able to change that, those parameters, those rules, it's definitely something you want to go for. If you're spending 90%, 95% of your time going through alerts that at the end of the day are false positives, you're wasting a lot of time. You don't want to dedicate so much time to those types of things. So certainly if there are those situations where you think adjustments are helpful, it's certainly a good idea to go ahead and do it. Obviously, make sure you document it, your reasoning, why you did it, the date you did it, that kind of thing, because those are the types of things that examiners will be looking for when they come in to do your exams. Okay. And lastly, a big thing on automated software is the independent validation of it. When you have the automated software, it's be pulling all this data for you. But if that data is not being pulled in correctly, if it's not capturing the right information, essentially your software is not doing everything it should be doing, and you could be missing a lot of suspicious activity. So the thing that we strongly recommend, and we see examiners more and more pushing for this, is some sort of independent validation of your system. The independent validation basically makes sure that the automated software literally is pulling all the specific information that it's supposed to be pulling from a data standpoint. How is this done? Again, we've seen a few things out there. We've seen internal audit departments do it. Third-party companies such as Wolf, we certainly help institutions with respect to this. The big thing is it has to be independent. So, the BSA staff, for example, shouldn't be doing this validation. I've seen people argue even that the IT staff shouldn't really be doing this either, at least if they're, involved with the day-to-day IT types of activities. Certainly if you have an internal audit department, IT audit department, something like that, that certainly might be a great party to do it. All right, the last thing I want to discuss as part of the session always seems to be a big thing under BSA is enhanced due diligence. So I know we talked a little bit about customer due diligence earlier on in terms of what FinCEN is going to be proposing in the future for beneficial ownership. I'm just getting a little more detail here in terms of the current rules and the current expectations that are in place in terms of your enhanced due diligence. Obviously, the overall gist of enhanced due diligence is that you want to be spending more time and more effort on those customers or members that are posing higher risk. So basically, the higher the risk of that particular customer, the more effort you should be spending from a standpoint of monitoring their activity, collecting documentation from them, verifying them, things like that. Obviously, the enhanced due diligence process, it's an important piece of the program, and it kind of flows throughout the entire customer relationship. It really starts from the moment you open the account, and it's really continuing on until you close the account out. I have a few slides here discussing the key features, the key things that we look for from Wolf's standpoint when we're doing BSA reviews, but also what examiners are looking for when they're doing their examinations for enhanced due diligence. Obviously, a big thing from a policy standpoint is you want to have a formal process in place. You want to have formal standards in place. So, you don't want, people kind of informally deciding what risk ratings are. Ideally, you have a written policy that states exactly what your risk ratings are, and more importantly, what are the conditions that are going to constitute those risk ratings. So, for example, these types of, customers are high risk rating. These types of customers are moderate risk rating, something like that. Or maybe, the customers showing these types of features are high-risk customers, something like that. All right, your due diligence should obviously be commensurate with the risk. It kind of goes without saying, the higher risk the customer is, the more documentation you should be collecting from them, the more enhanced your monitoring should be of them. Obviously, because they're higher risk, they deserve more attention. Low-risk customers, hence, don't deserve as much attention. It's kind of similar to what I was talking about on the automated software. You don't want to spend 90 to 95% of your time going through something at the end of the day is ultimately a false positive. And it's the same thing with EDD. You don't want to spend too much effort on your low-risk customers. You want to spend more effort on the high-risk customers because that's where the risk is. All right. Typically what we see, typically what we're seeing examiners expecting from an EDD standpoint is that you're establishing this risk at the time that you're opening the account. So basically, you're establishing an account relationship. Ideally, at that point, you've established some sort of risk rating for the customer. Now, it doesn't literally have to be the very second they open the account. If it takes a little bit for the account documentation to go from the branch to operations or to compliance or BSA. I mean, that's generally acceptable. You don't want to see, for example, is, waiting several months to assign a risk rating, because obviously activity is going to happen there. And you want to be well prepared in terms of what documentation you have acquired from the customer and what work you've been doing on it. You want to make sure your risk ratings are applied in a uniform fashion, so just make sure you're consistent. Again, this is really where having it in writing in a policy document really helps, because you can officially say this is exactly what we're looking for in terms of the standard. You could have a great rating system. If people are rating things incorrectly, you're still going to unfortunately have a waste of time at times. You might miss things that you should be catching, and you can certainly get audit or examination criticism. So you just want to make sure things are uniform. Again, if it could be centralized, that's certainly a great thing. I can't say it's officially required to be centralized. If it's not centralized, if individual branches are assigning risk ratings, again, just make sure you fall back on that formal policy, that formal methodology, and ideally have some sort of review process, so you don't have one branch rating things completely differently than what all the other branches are rating things as. All right, risk rating's never permanent. It's not going to stay forever. So certainly be ready for situations where you may have to change the risk ratings of the customer, and obviously that will then, in turn, change the actual monitoring on the due diligence you have to do on them. So, for example, if it's triggering events, you might want to up the risk rating. For example, if you have a customer that you've filed a STAR on, if you have a customer where you have a positive 314A match, or maybe they're subject to a 314B request, maybe they're subject to a subpoena, search warrant, something like that. These are situations where, in all law, this customer is posing us high risk, based on the specific scenario that we've seen come about. And vice versa as well. I mean, you might see high-risk customers where you're reviewing their activity for a long time and absolutely nothing of consequence whatsoever is happening. And you might be able to say in situations like that, you can actually even lower the rating. Just like the initial placement of the risk ratings, again, the key, I think, is make sure it's documented. Ideally, it's in a policy in some fashion or a written procedure so people know exactly when these happen. And then just make sure that whenever you do make any changes, that that's properly documented. I've seen a bunch of things out there. Again, I've seen institutions that look at ratings every year. I've seen institutions that do a reassessment essentially after 3 months after the account's opened. There's no official standard, but it's definitely good to have some sort of process in place to be able to say, all right, we're flexible here. We can adjust our rating if we think we absolutely need to. Obviously, your monitoring, your actual due diligence of the customers should be tuned based on the risk. The higher the risk, the more frequently you should be doing it. The lower the risk, the less frequently you should be doing it. I've included an example here, and again, this is just an example. No reg says you have to do it this frequency. My example says, for example, high-risk customers every quarter, moderate-risk customers semi-annually, low-risk customers really only if you have a triggering event, such as through your monitoring process, your software. Again, if you have one of those scenarios I mentioned, like they're a STAR suspect, a 314A match, something like that. A big thing, you want to make sure you stick to your schedule. You want to make sure that accounts are monitored at the frequency that your policy is established. Definitely a thing you can be heavily criticized for is if you've got a great policy in place, you've got a great standard in place for how frequently things should be monitored, but you just can't keep up with it. And once you start falling behind, get some kind of snowball, and all of a sudden you might be missing a bunch of activity because it's taking so long to monitor it. As a result, the STARs may not be filed in that timely fashion. Things like that. So you just want to make sure that you're sticking to your schedule as best you can. And certainly if you have any changes, you want to make sure it's based on the risk. So for example, examiner is not really going to look too kindly if you say, all right, we developed a quarterly schedule, but we just didn't finish this month, so I'm going to switch to a semi-annual schedule for my high-risk customers. If they see you doing something like that based just on volume and not on risk at all, you can certainly be criticized for that. So just watch out for those situations. Okay, and then lastly here, just make sure you maintain the appropriate documentation. Examiners and auditors definitely going to be looking for evidence that you actually did the monitoring. So, in whichever fashion you do it, whether it's having a folder for high or moderate risk customers, having a spreadsheet that tracks your process. If you have the automated software and there's a field where you're able to specifically type up the monitoring you've done, document the monitoring you've done, that's a great thing as well. Okay. So that pretty much covers things. So at this point, we're going to open things up in case we have any questions from the audience.
Great. We do have some questions, but if anyone wants to send in your questions, please do so now. If Brian doesn't get to all the questions that came in, he'll definitely be following up with you post-webinar. So with that said, we will be back in just a moment to answer the questions that have already come in. All right. The first question for Brian is the 15 days business or calendar days?
So the 15 days, and again, to recap, that's with respect to the CTR filing. So under CTR filing, it's calendar days. So the official rule when you're doing it in paper form was 15 calendar days after the transaction. The 25 days also calendar days as well.
Great. This beneficial owner concept sounds like it is for business account owners.
Yeah, it seems to me as well, again, at least looking at the initial proposed rule, that's the overall gist of it. You know, when you're establishing business or you know, organization accounts, they're looking to get more information on the beneficial owners of those types of entities. Obviously, typically for a consumer account, you've got the beneficial owner typically sitting right in front of you because you're using the account. You know, and you may have situations like a trust or something where you don't necessarily have all that information. But yeah, you know, at least from my view, you know, from reading the proposed rule, it looks like they were looking at businesses, organizations. Admittingly, you know, things could change when they actually get the rule out there, but that appears to be what they're looking for there.
Great. You suggest reviewing risk rating of all customer base?
I would say so. Now, exactly in how much detail you get to can vary. You know, I've certainly seen organizations say that, you know, the large majority of their consumer customer base is low risk. And typically that's fine. You just want to be a little bit cautious. I mean, certainly there are consumers out there that could pose you higher risk. SAR suspects, positive 314A or 314B matches, OFAC matches. You know, we've seen politically exposed persons, non-resident aliens, things like that. You know, your typical local consumer who isn't any of those things. You know, typically, you know, you have to worry about much of those, you know, as you would business entities. Obviously, the businesses is a really big thing on the business accounts. You know, that's really where you want to be really careful. You want to make sure you definitely risk rate your business accounts. Most organizations I deal with have moved to the questionnaire worksheet method at this point, or, you know, certainly they have the automated software that does it as well. So yeah, I mean, definitely from a risk rating standpoint, it applies to all your customers. Obviously, the amount of work you'll have to do, you know, will obviously be a lot more for businesses versus consumers, though.
Okay, our next question, should or must how a bank handles CTR aggregation be addressed in the BSA policy?
I'm going to say two things about this. I'm going to talk about aggregation in general and then the new aggregation guidance. So I would definitely say you want to have your BSA policy and written procedures to discuss CTR aggregation in general. Obviously, in general, I'll just give a very brief example. $6,000 deposit at one branch, $6,000 deposit at another branch in the same day. You're required to aggregate that, and I would say, you know, something basic like that should be in your BSA policy. If it's as simple as a statement like, you know, any transactions aggregating to over 10,000 in a single day at any branch location, you know, will be reported on a CTR, something like that. If we're talking about this new aggregation guidance, you know, I wouldn't worry as much about that. You know, you may even turn around and say, we have no situations like this based on our customer base. You know, if you are facing situations, it's always good to be in writing. You know, the one thing I'll always say, and certainly if any of you have worked with me, you probably know this, you know, there's never a problem with having more things in writing. You know, it's always good to have extra procedures documenting things like this. I can't really say you're officially required to put this in written policy, though, or written procedure. it's certainly a good practice to do, at least if you're an institution that has a customer base where you might be facing these situations. If you're really not, then maybe something to let people know about, put in a training session, put an email to let people know might help, and maybe in that case you don't necessarily have to put it in procedure or in policy.
Okay, our next question. I just want to confirm, for supplemental SARs, we should refile, if appropriate, at 120 days rather than 90 days?
Yes, you are allowed to now go up to 120 days. I can say this has always been the case. You can always do early if you want. So if you want to do it 90 days, 100 days, that's fine. Basically, what the new guidance had said is that, in the past, you had a 90-day cap. So essentially, if you had not filed the next SAR within 90 days of the previous SAR, you're going over that, and they were still doing the suspicious activity, essentially they're considering that late. This new guidance has said, all right, you've got a 30-day investigation window that you're allowed to use after the 90 days is up. So effectively, if you file the SAR, if the activity is still happening, just get that supplemental SAR filed within 120 days of that previous SAR. So, if 115, it's done at 115, that's fine. Just don't, want to not try and go over 120.
All right. Our last question for Brian, and as I mentioned, if we didn't get to your questions, he will follow up with you directly. In the event your institution does not have a risk rating system and methodology for all customers and performing an EDD, what is the best way to start to develop one?
What I would recommend, the first thing I'd probably recommend is, really you want to establish a methodology first. You want to establish what is high risk, what's moderate risk if you want to go ahead with a moderate rating. If you just want to do high or low, I've seen that as well. But basically, yeah, you want to establish that full methodology. In terms of how to get there, there are good BSA resources out there. Certainly the FFIEC BSA examination manual is a good source because that manual identifies all sorts of different types of situations where business product types, business customers are higher risk. Showing things I've seen out there as well is if you go to the exemption requirements, there's a list there of business types that you can't exempt. That's a great place to go to as well to say, hey, these are the types of entities that we want to consider as higher risk. So it's probably a good place to get started. So yeah, my advice would be to just start with the methodology first, identify what do I want to consider high risk. You might have audit results, you might have past history results to look at. If you've had some SARs on people, what was the type or nature of activity from that person? What was the type of business from that person? That could be a good resource as well. Once you've established a methodology, then you kind of go ahead and say, all right, how do I want to establish the formal process? Again, I've seen most institutions out there use worksheets or questionnaires. I've seen some institutions have a review after, let's say, 3 months after the account's opened to determine a risk rating at that point to say really what's going on there and how should we establish it. Some institutions use the automated software as well. So hopefully that's enough guys to get you started. And certainly if not, feel free to ask us for more details. I'm sure I can help.
Great. And Brian will be following up with any questions that were not answered today. And of course, his contact information is up on the screen. So feel free to jot it down if anyone does have any other questions to ask Brian. Certainly a lot of information that we went through today. So I want to thank everyone for joining us, and as a reminder, copies of today's presentation slides as well as the recording will be available at www.wolfandco.com/webinars/2012. And immediately following the conclusion of this webinar, you'll have the opportunity to complete a survey. And as always, we appreciate your feedback so that we can continue to improve our webinar program. And our next webinar will be held on Wednesday, August 8th. So if you are interested, the webinar is on enterprise risk management and the role of the Chief Risk Officer. You can just go on our website and register for that webinar if you didn't already receive an invite. So save the date for that. And thanks again for attending. And Brian, thanks so much for presenting today. And we look forward to your participation in future webinars. Have a great afternoon, everyone.